Okay, everybody. So my name's Rodrigo. I want to give everybody a very, very good welcome here. Just give us a quick minute here because we're setting up the Twitter stream on the other side, folks. 1 second. But basically, we're going to be having a live trading school demo here with Mark Putrino, former hedge fund manager and also lead trader at and chief educator at the Benzinga Trading School. Let me just make sure here everything is set up. Up the Okay, so we should be sharing the school here. Let me just make sure we're getting that out. Um, Trading school, great. All right. So we're going to be talking about trade ideas, education. We're going to be talking about a whole bunch of different things here with Mark Putrino. We're going to be starting here in about a minute or two, just making sure that everything is pretty much good to go. It looks like the Zoom is good. Let me just make sure. All right, I think we are good to go on this side. So without further ado, let's go ahead and bring on Mark Putrino, former hedge fund manager and chief educator at the Benzinga Trading School.
Hey, Rodrigo, what's up?
Hey, what's going on, Mark? How are you?
Pretty good. Pretty good. Let me just make sure I got everything set up here.
Yeah, how was the class today with the students?
It was good. It was good. Today was our class on levels, and we also spent some time talking about the economy, what's going on here with the Fed, because because we have this Fed meeting on, or no, I'm sorry, not the Fed meeting. Let me restate that. We are going to get our GDP reading on Wednesday, and if we get a negative one, then that would fit the definition of recession. And I think that there's a good chance that it comes in lower and that we are in recession. And the reason why I say that is because everyone's been talking, inflation, inflation, inflation. Well, over the last week or two, we've seen dramatic drops in the prices of copper and wheat. So that could be due to an economic slowdown, which could be here, quicker than people think. So I think there's a good chance we get a negative GDP on Wednesday. And then the question is what happens? What does that do to the market? And I mean, we're going to have to wait and see. But I think kind of what I'm thinking is, if we get negative short term, that's going to make the market bounce because people are going to think, oh, we don't need to raise rates as much. But after a few days, people are going to start to say, wait a second, a recession is not a good thing. So let's start to sell. So there's a lot of stuff, a lot of interesting stuff going on right now.
Right, there's definitely a lot, and I know that you do cover all that in the trading school because for those that are not aware, basically you're a chartered market technician, you're a former hedge fund manager, you traded with Steve Cohen, Mario Gabelli, multi-billionaires, 35 billion plus, and you've been a market maker, you've been all around Wall Street, right? So I think it's just really good to have that experience when it comes to helping new traders. There's a lot of misinformation out there. There's a lot of fake gurus. We all know that, pump and dump chat rooms. And I think it's just a very noble cause, really, what you're doing here, Mark, for the students. Just seems like a very noble cause when you're helping the students figure this stuff out, what's happening with the Fed and all this in real time, right?
Yeah. And unfortunately, I'm old enough to have a lot of experience, and there isn't much I haven't seen before. So what's kind of interesting is what's going on now that the market's going lower is just a lot of the similarities to the stuff that happened after the NASDAQ bubble and then the housing meltdown. So a lot of our students are younger or maybe newer, and they've never really traded a bear market. So a lot of them didn't really know what to do. But as it turns out, there are a lot of ways you can make money when the market's going down without using any kind of like sophisticated derivative strategies or anything like that, just by just by understanding that there's like these ETFs that people can buy, that if the market goes down, the ETF will go up. So, the market's been getting hammered. Obviously, we're up over the last few days. We first started getting bearish in December and November, because there are a lot of the market internals really kind of started to give way. But basically, the class is based on my experience as the head of trading at 3 different funds. So I traded for Mario and then for Stevie. And then I did 3 different stints at 3 different money managers, which all lasted about 5 years, where I was the head of trading. So I've overseen pretty much every kind of style you could possibly think of. But yeah, so there's a lot that we bring to the table. But when I was the head of trading, one of the things that typically happens in a typical, not every fund, but a typical fund, is the traders are the people that see what's going on in the markets. They're watching the markets every day. They're watching the levels. They're watching the levels. They're watching the news. The analysts and the portfolio managers, those are my guinea pigs for going crazy for some reason. I don't know what. Anyway, the portfolio manager is the person who ultimately decides what goes in the portfolio. What do they buy or sell? The traders are the people that decide how to buy and sell it. Then you have analysts who support the portfolio manager. So this class is based on my experience of conducting the morning meeting, because basically the trader has to know what's going on in the market, and you conduct the meeting and you say, all right, well, here's what we're looking at, this, and that. So everything changes a little bit. Everything changes. No 2 days are the same. But what are the same, actually? The first part of the class, we have 8 classes, and in the first part of each class, we talk about a basic market principle or fundamental. And then the latter part of the class, and during our afternoon class, we look into the actual market to see how the principles that we studied in the first part of the class can be applied into the real market and into profitable trades. So today was our patterns class. Tomorrow's investment psychology. But as long as things are always going to change, right? People will always change. People will always change. The names of the companies will change. But what doesn't change is human behavior, right? And human behavior. So that's where we talk about investment psychology. And then our basic principles of markets. Like, as long as there are financial markets, there's going to be some price levels that are more important than others. As long as there are financial markets, there are going to be support levels and resistance levels. And things are going to be driven by momentum, and things are going to be trending. So that's what we study. We have 8 classes. And when you're done with the 8th class, you start again and we recycle. And a lot of the students that have been with us since the beginning, now they've seen the market top, they've seen market sell-offs. Markets act differently at different times. So it's a real kind of an in-depth analysis. Like, our main thing is technical analysis, but we talk about other things too. Like today, we're talking about Fed policy and easy money, and how the monetary policies of the hard money and the gold standard of Grover Cleveland caused the economy to go into a depression in the 1890s. And that's relevant now because one of the problems we're having now is monetary policy, right? They overdid the monetary policy, so that caused inflation. Well, back in the 1890s, they should have done some monetary policy, but they didn't, and that caused deflation. So a lot of people say that depression was even worse than the Great Depression. There were some states where the unemployment was 50%. So we kind of improvise and go through a whole hodgepodge of different things, Rodrigo. If you want, I should take the screen and show people some stuff.
Yeah, let's go ahead and share your screen so that you can show a couple charts as well there, and do a little bit of a in-depth market review with the folks here.
Okay. All right. Well, first of all, let's just look at this. This is usually how we start our day, looking at the S&P 500. This is the spider. It's an ETF that tracks the S&P 500. But basically, it's kind of the same thing. Like, if this is at 389.2, we know the S&P 500 should be at 3,892. We look at this because this is what people trade. And we could see some stuff going on here. But one of the things I will say right off the bat is that since 1929, there have been 25 bear markets, and that's defined by a market that is more than 20% off of its top. So it's happened 25 times. The average decline of those 25 times has been about 35%. So if you go to our recent high and you go down about 35%, that puts you right around the 320 level. And just coincidentally, or maybe not coincidentally, one of those weird market things, if we got down to this level where it would be the average sell-off for the 25 bear markets, that would put us right in line with historical valuations. In other words, like price to book ratio, price to earnings ratio. So there's a good chance that this market keeps going lower. And, I know we've had a nice move higher here, but we were so oversold and our sentiment was so bad. But this chart here illustrates a pretty interesting principle. And this is why a lot of the students were able to rack up some nice returns on Friday. Okay, so we know this, there's this concept, right, or a fundamental of markets is price levels are more important than others. For some reason here, I don't know why, but SPY decided that it likes the $415 level. So after this sell-off, it became support here. Then we had a rally, came support again. Then we broke down. Now guess what happens? A lot of the people that bought back here around 415 in early March, they thought that they made a really nice move when the market went higher, right? But assuming they didn't sell and they're holding on to it, back here in May, the support broke and it went lower. So now a lot of the people that bought here and bought here now have buyer's remorse. They regret buying. They're like kicking themselves. It's like, I shouldn't have bought that. So they decide to get out of their positions. But here's the thing. They don't want to take a loss. And I'm sure a lot of people listening to me right now have probably gone, through the same thing. They buy a stock, it goes down. They don't want to take a loss. So they tell themselves, oh, I'll get out at break even if I can. So we have these remorseful buyers who bought here, placing their sell orders over here. So there's enough of these sell orders, the level that was support can turn into resistance. You can see the same thing happen down here. We had this low trade here, which was right at 380. So this is why I say a lot of the students did well on Friday, because markets make big moves when they break through important levels or when they reverse off of important levels. So one of the most important concepts of our class, and I think of successful trading, is to understand how to let the market tell you what to do, right? It's okay to stay on the sidelines until you see something that looks like it's pretty compelling. So now we have the kind of precise situation here, right? We have a level that was support has turned into resistance right around 390. So if it looks like this resistance at 390 is going to break, meaning we trade above it, there's a good chance that we get a decent move higher, because we don't see another important price level until we get up to around 408. So I don't know if we're going to get any kind of significant movement today or tomorrow ahead of the GDP report on Wednesday, but it just goes to show you how important it is to understand where these important price levels are, right? And in the institutional world where I come from, no one's looking at things like harmonic charts or Elliott waves or Gann theory. We're looking at stuff like this. Where is the level? What's the momentum? Where can I buy it? Where can I sell it? Let me show you an example here of our technology sector. One of the things we do every day in the class is we go through the various sectors to see, just to get us insight, right? The S&P consists of 11 sectors. And if you examine what's going on within the sectors, you can get some good insight into what is going to happen with the broader market. And then from there, obviously, we can come up with our trading ideas. But when we were going south here, when the market was selling off, actually, let me go to the S&P. All right. So when the S&P was going down here, all right, this is where the whole Ukraine thing started. Ukraine and all the media was talking about how the market was going down because of what was going on in Ukraine. Right now in the class, we talked about, no, the market is not going down because of what's going on in Ukraine. People are completely over exaggerating it. And just think about that. That might kind of strike you as being a little counterintuitive, but if the market was going down on Ukraine, then why did it go up when Ukraine was still going on? Right. So let me tell you the real reason. Well, the market's selling off. And it just so happened that the technology sector, which was the biggest part of the market, happened to find support right around this 141 level. Why was there support there? Because it was a resistance level way back here. So this is an important level. So this is what told us that the market was going to turn around. We look into the past and we look for levels that were important, because when the market gets to them in the present, if it was an important level in the past, there's a chance it's going to be important again. And we can see here some of the same stuff, right? Support turned into resistance. So it's a lot of students, I think, are pretty amazed when they look at this stuff. Like, look at this. Like, where did XLK turn around? Did it just turn by some random act of, random act of the market gods or whatever? No, it got down to 125 and it found support around there. Why? Well, let's go back here. It was support in March of 21, and it was resistance in the latter part of 20. So for some reason, this 125 level is important. So if something's selling off and you want to think about, like, oh, gee, I'd like to buy it, you don't want to just go out there and just guess. You'll catch a falling knife, you'll get run over. But if you look into the past and say, oh, wait a second. No, when this thing got down to around 125, it found support last time. It's around 130. I guess I'll wait till it's around 125. Right. And then you would buy it there. You wouldn't be guessing. And in this case, you would have gotten a nice move higher. The same thing with things going higher. Like, I get a lot of questions about people like, oh, I bought this, I got a profit. Where do I know where to take my target, my profit? Where do I get out? Where do I get out? Well, it's the same concept. You look, say you bought it down here, it's going higher. You look into the past. Oh, this particular level here was support. Then it was resistance. So this would be a good place to have my my sell target. So if you know where these important levels are, Rodrigo, then it makes it much easier. Oh, actually, you know what? I just want to show everyone this just to see something that is pretty interesting. And oh wait, let me just see here. I got to bring up a different chart to show you this, but this is pretty cool. A lot of the people who are listening probably have heard the expression, the market has a memory. And what that refers to is the fact that certain price levels can stay intact and be important for a long time. So this is CVS here, right? The drugstore. And back here on this particular day, which was February 8th, they reported earnings and the stock acted strong. Where did it hit resistance? Right around 111. Now watch this. Let's go all the way back in time to August of 15. And guess what? That was resistance back there. So this is what people talk about when we say the market has a memory. So here we are 7 years later, 6.5 years later, and the resistance is still intact. We can go look down here at support. We had support here around 52 in March of 19. It was support again during the COVID crash. So a year later, it found support at the exact same level. And up here, we see once again our concept of what was resistance turns into support. So if this thing was selling off and you were thinking, oh, I want to buy it, where should I buy it? You just look back here. Oh, well, looks like 90 is important for this guy. I'm going to wait for it to get to 90. So I think, Rodrigo, a lot of students have like an epiphany when they realize that they've been looking at the market completely wrong, and it doesn't need to be as complicated or as convoluted as they think it is.
Right. Well, Mark, these markets are, I'd say we are, in historic times, and there's a lot of stuff happening with the Fed, with a lot of things happening, overseas that are just new factors into the market. So as a new trader, I mean, it's different if you would try to learn as you go in 2020 when everything was just going up. But the markets are so volatile right now, Mark, that as a new trader, it must be a slaughterhouse there. So I think this is good to just keep in mind because this is just one of the classes. But I think that like you have 8 chapters total, but none of like it doesn't matter what you learn really. If you don't have the psychology part of it, the mindset of the trader, it's going to be difficult, right? And I believe you have a class, investment psychology. That's the one that I always try to make sure I'm watching the replays or the recordings. But how have you seen that help traders throughout the sessions, since we started the school here?
Well, I think to a lot of people, I think it's kind of it's also kind of like a revelation. Now, let me kind of go back here. And when I was working for Cohen, this is probably, 1999-ish. He gave what, I don't know this for sure or 100%, but I remember them saying this is only the second interview he had ever given. This was before he was like a household name, before he bought the Mets and to show billions is supposedly about him. But anyway, the Wall Street Journal calls and they're interviewing him and he's on the trading desk and we're all listening to what he's saying. And the reporter kept saying like, well, what trading systems do you use? Do you use this? Do you use moving averages? Do you use momentum? And what Steve kept trying to say over and over and over was there's a lot of trading systems that actually work. What the problem is people don't have the right mental outlook to actually stick with them, right? So, you buy something and it starts to go lower. Instead of just taking a small loss, you hold on to it because you're just afraid of losing money and ruining and hurting your ego. And it just goes lower and lower. So a lot of people think that the guys like the Steve Cohen's or the Paul Tudor Joneses or the Jesse Livermore back in the 20s, these great traders have developed this like secret formula that they use. And that's just not the case. That's not how it works in the real world. These guys have losses too. And you would probably be surprised to see how many losses they have in terms of like your win ratio, right? But if you follow the proper risk management psychology, you could win on, I would say they won maybe half the trades, but here's the thing, right? You're going to have either a break even, small loss, or a big loss, or a break even, small loss, or a small gain. Those are all going to offset each other. So then you have big losses and big gains. So if you can eliminate those big losses, then the winning trades will take care of themselves. So that's part of the psychology. People guess, money makes people do irrational things. And I don't know why, but I just think it's pretty, interesting how okay, sorry about that, Stella, distracted there. Now I forgot what I was saying. But yeah, when it comes back to the psychology, when people join the class, I say to them, like, why have you lost money? And almost 90% of the time, it's one of two things. It's well, I guessed, which is an emotional decision, or I have a plan, but I didn't stick to it. And that's where you don't have the emotional wherewithal to hold on, right? So think about this. If you're paper trading, it's easy to paper trade and to come up with a profitable strategy on paper. Just say that you happen to have a trading system where it calls for you on paper, you don't have any real money involved, to buy 1,000 shares of something at $10, right? And your system says sell it if it gets to 15. So that's a 50% return. So you go and you put it in, or you do your paper trade and you watch it go to 11, 12, 13, 14, 15, and you're like, oh, this is easy, man. I just made 50% of my money. I figured out with this paper trading system, it looks like I'm going to be able to be really successful at this. But what happens in the real world when people put real money on the line, right? You've invested 10 grand. Now it goes to 11, right? Like Spinal Tap goes to 11. But now it's like, all right, now you're not looking just at paper anymore. Now you're looking at $1,000. Now say it goes to 12. Now you're looking at $2,000. It's like, wait a second, I got a $2,000 gain here. I don't want to, I don't want to lose this. So I'm just going to go ahead and sell it. And then you watch it go to 15. And then you think, oh man, I got out too early. So that's the difference between paper trading and actually putting real money on the line. And what I say to new people is, come up with your strategies and your trading systems on paper, right? But don't put too much, don't get too caught up in perfecting it. Well, I shouldn't say that. I mean, get it until you feel comfortable with it, but then put some real money on the line. And not so much that you're going to get scared or you're going to do foolish things, but just enough so you could kind of start feeling the emotions that are involved. I know depending on what your risk threshold is, we have students that are trading very small amounts. We have students that are probably quite wealthy. But they just put in a little bit. I don't know if it's $500, $1,000, just enough to know what it's like to start feeling those emotions, because that's really what's going to bring you to success, right? It's like, I like to use the boxing analogy or whatever. You can do all the working out you want. You could lift all the weights you want. You could think you're in great shape. You could think you're ready to box, but until you actually get in the ring with someone else, you don't really know what boxing is all about. And it's kind of the same thing with trading, right? You can study all the models and all the systems and, this, that, and the other thing. But until you have real money on the line and you start feeling those emotional pulls to, sell something or hold on to something that's a loser for you, you're not really going to understand what it's really all about. So risk psychology is a big part of the puzzle. And, people ask me, what's the secret to trading? And sometimes people think I'm just joking around, but the answer is, well, you got to understand that as a human, you have evolved in a way that's not conducive to making good trades. When you get money on the line, it makes you do irrational things. So that's what we talk about in our investment psychology class. I'm not saying you got to be like a Buddhist monk and, completely master your emotions, but I think just having an awareness of it is enough to really kind of help you along the way. So I think a lot of people, Rodrigo, they come to the class and they don't know why they lost. And then when I ask them, they say, I guessed. And I'm just like, all right, well, you lost money because you were making an emotional decision.
Right. And I guess this would, for the traders that I talk with, and it seems to be a very similar thing where it's like, as soon as I buy the stock, it goes down like clockwork. Right. And I guess that's really a moment to emphasize really how important understanding technical analysis and really understanding the language of the charts comes into play, right, Mark?
Yeah, I mean, I look at it like this. To me, the chart is like a map. You know where the important levels are. And I think if you're not looking at a chart and you don't really know how to read it, I think it's really analogous to you go to some town you've never been in before and you want to drive around and you don't have a map and you don't have a GPS. So you're just not going to know where you're going. If you have the chart and you see, oh, like this important level here, it could be equivalent to like, oh, that's Main Street, or this important level over here, that's Maple Avenue or whatever. Yeah, having the charts is if you can't read a chart, you just can't be a trader. I think it's pretty much that. I think it's that simple.
But it seems like a lot of traders overlook that. It's just like, oh, no, I know that. But then at the time of trading, it seems to be an issue for the most part. It's one of those things, I guess.
Yeah, I mean, we talk a lot in the class about how you have to let the market tell you what to do. You don't want to guess. You got to kind of be agnostic. It's fun to talk about, oh, the market's going to go up, the market's going to go down. But if you do that, that kind of gets you trapped into the psychology thing that we're talking about, right? Like if you say the market's going to go up and you tell all your trading community friends the market's going to go up, that could give you confirmation bias where you might not recognize or you tend to ignore things that might tell you that you're wrong and that the market might start going down. So we come into it with like an agnostic point of view and let the market tell us what to do. And the market speaks to us by how it acts when it gets to important price levels, right? If we get to an important price level, the odds are that it's going up or it's going down. If you get to an important price level, it's not very likely that the stock is just going to trade sideways around those levels, for an extended period of time. So a big part of success, and this also goes back to our risk management, or our psychology class, is knowing when to wait and knowing when it's okay to stay on the sidelines and wait for a big move to come along. Like, for example, the S&P is flat today, but we talked about how it's at this important level. Well, right now, I wouldn't be doing anything. I would just be waiting to see. And if it doesn't look like we're going to get through this level and we start to go lower, that's the market saying, hey, man, we're going lower. If we start to break out and move higher, then it's market's telling us we're going to go higher. So like we broke out above the 380 level, which we watched for 2 weeks, and then wham, we got all of a sudden we got all the way up to 390, like in one day, right? Now, I think if we move higher, the next level of resistance is for SPY is going to be around 408. And if we move lower, we'll probably find support at that 380 level again there. So as of right now, we're kind of trading a little bit down on the day, but it's not really big enough to, it's not a big enough move to really kind of tell me anything decisive one way or the other. And I think we're probably going to be quiet, and we'll probably be quiet tomorrow too. And then we got the GDP report coming out on Wednesday, and I think that there is a good chance it's going to be weak. And one of the reasons why I say that is that the Federal Reserve Bank in Dallas, and this is what's amazing about Powell, right? It's like he speaks to the Congress or whatever, whoever he was talking to, and he said he saw, and I'm using his exact words, he saw no signs of slowdown in the economy. The same day, the Atlanta Federal Reserve reduced their GDP estimate from 0.9 to 0. So I don't know what he was looking at here. But if we look at this here, I mean, there's 12 Federal Reserve banks, and Powell is supposed to be in charge of them all. So it's pretty amazing that he doesn't see what's going on. But this Texas one, the Texas Fed, it's in Dallas, they just put out some dismal numbers here on manufacturing. The Texas manufacturing outlook, the production index fell from 18.8 to 2.3. That's the lowest reading since May of 2020. So this is something I didn't even see, but one of our students pointed it out. General business activity declined 10 points to minus 17.7. So this is a really an abysmal kind of support here. So it really shows a slowdown in the Texas area, assuming they're looking local. We've seen copper prices, wheat prices come down. So I think this is all slowdown characteristic stuff. And I would not be surprised to see the GDP be negative on Wednesday. Then we get the bounce because people think, oh, GDP is negative, we're not going to cut rates anymore. Then let it sink in, after a couple hours or a day or two. And it's like, oh, well, actually, recession is bad for the market. So things are going to go lower. So people start selling. So, I've been around long enough. I've been around the block enough times that I've seen stuff like this happen. I'm not saying it's going to, but I'm just saying it seems like it could be a pretty likely scenario. So that's on Wednesday. So
right. And really quick here, Mark, I'm getting a lot of questions here on both of these, on the YouTube and the Twitter side. So folks, if you do want to join Mark Putrino during the trading school, basically so you can trade with him, learn with him, go through the sessions. There's a 7-day trial for $7 on Twitter. If you want to look into it, it's in the top. We pinned it up there on the Twitter space, and on the YouTube side, you can check it out on the description or the chat. But basically, Mark has classes Monday to Friday for about 3 hours a day. And you also get his trades. You also get our research terminal, which is Benzinga Pro. It does come with the school, but yes, Mark does go over all this stuff, and there's a lot of chapters, but there's a lot of other small things that you will learn throughout.
We also do the newsletter every week, Rodrigo.
Yeah. What is the newsletter for those folks that just joined here?
All right, well, here is it on the screen. And I just kind of do this because I'm just, I don't know, just to make it a little bit entertaining, right? So I put this out. I try to get it out on Sunday night. And basically, we just cover what we're going to be looking at during the week. But, it is a class and it's educational. And I think by learning about historical events, it helps you understand the market better now. So the reason why I have a train on here is because I'm talking about the Great Depression of the 1890s. One of the things that caused that was a bubble in railroad stocks. Just like we have bubbles in internet stocks and bubbles in the Reddit stocks, back then they had bubbles as well. They overbuilt. They had literally, people said, oh, it's a train to nowhere. And that caused the market to go into a panic. The market crashed in 1893. So that's something that we can see is relevant today, right? It's a bubble, but it occurred in what were the hot stocks of back then, were railroads. But then we get to monetary policy. And the reason why we went into this long depression is because President Grover Cleveland was really fanatical about the gold standard. He said that, gold, people that were into the gold standard think that for every dollar in circulation, there should be a dollar of gold in a vault somewhere that backs it up. They almost look at it as like it's like this moral thing. Whereas like quantitative easing, like we see now, adding money to the economy, they thought was like an immoral thing that people shouldn't do. But here's the thing: when you have the economy expanding in the sense that more people are coming into it and so forth, and you don't increase the money supply, what you get is deflation, and prices start going down. So, like for example, cotton farmers, the price of cotton fell 50% from 1872 to 1877. Right. So we see here, 130 years later, but we're seeing similar things. So if we go here to the end, I do a little bit of a historical thing here. This is Grover Cleveland, and he is considered a failure as a president, at least the second term, because he couldn't get away from this gold standard thing. This is kind of a funny picture here too, for those of you who can't see it. It's JP Morgan wearing this top hat. And one of the things we talk about where it's, it seems kind of funny, but it's applicable to the markets, is fashion. Because we look at this top hat and we think like, oh, that looks silly. But back in his day, everyone looked at top hats and thought like, oh, that's cool. Those are the nice hats. So what is that? That shows that people have this tendency to have a herd mentality. You have a tendency to get sucked into the herd and you might not even realize it. And this same thing that makes you drawn to fashion could potentially be something that makes you lose money in the market. Like if you get susceptible to the herd mentality and you're in some chat room or something and everyone starts doing one thing and you just kind of jump in and go along, that's a good way. That you're guessing. So that's a good way to lose money. So I try to just do it in kind of like a lighthearted, humorous thing. But yeah, so, history doesn't maybe repeat itself, but it certainly rhymes. So this is something we talk about. And then we would just have, besides the funny stuff, like real stuff about what's going on in the market. And, themes this week are, we had huge strength on Friday. We got the signs of the slowdown. We got the GDP. I like to do a trading lesson in each one. In this, we have this Canada Pacific. And, we have a support level here, which is pretty clear. And then we have what we call a bullish engulfing pattern, which is a bullish thing here. So I try to do a trading lesson every week. But yeah, I think I think, Rodrigo, if you want to be a trader or a good trader, we're really like, if we're technicians, we're really historians anyway, because we're looking in the past to find out where there are important support or resistance levels. But if you understand history and you can see that it repeats itself, or at least rhymes with itself, it just gives you much more insight and understanding of how the markets actually work. Because the names have changed and the people have changed and the companies have changed, but human nature hasn't changed. And that's what these charts are all kind of pictures of. Like I talked about how a support level can become a resistance level on a chart. Well, that's human nature. That's buyer's remorse. I would imagine if we had charts of financial markets from the Roman times or the ancient Greek times or ancient Egyptian times or what or so forth, I would imagine the charts would look just the same. You know, you'd have support levels becoming resistance, resistance levels becoming support. So the names change, the companies change, the players change, but what doesn't change, Rodrigo, is human nature. By understanding that, it gives us chances to make money.
Right, and that's part of the investment psychology class, I would assume, right? A little part of it.
Yeah.
Right. So basically, this newsletter, you pull it up every week. You make it for the students, right? When do you go over it with them?
Usually Monday morning.
Monday morning.
Yeah.
And basically, so when you were a hedge fund manager and all that stuff, you had like meetings in the mornings, and you pretty much run these sessions that you have with the students similar to that, right? Because you're also checking out stocks that maybe they talk about, like, hey, Mark, check this out, or hey, look at this news that's happening. These stocks are breaking out. Pretty much like live, ongoing mentorship, right?
Yeah. 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 It's kind of just like what we would talk about in a meeting in the morning, like our morning research meeting, which would usually be like maybe like 7 in the morning. And it's just like, you know, as a trader, I was like the eyes and ears into the market. And, you know, the portfolio manager wants to know, oh, there was a big seller of this stock was, you know, called us up and was seeing if we wanted to buy any. This particular stock that's in our portfolio just got to support. So if you want to buy some, you know, now's the time. Like a typical conversation would be, hey, Mark, listen, I want to buy, you know, I want to buy some CVS here. You know, I want to buy 1 million shares. Like, what should I do? And I would say, well, you know, it's oversold. It's at support. It's probably a good chance to go buy it. If something was overbought and at resistance, I would say, well, we're not going to buy it now. Let's wait. Let's back off and wait for it to come in. So by getting a competency with that over 20 years, that translates very well into giving people technical trading ideas, or at least teaching people how to come up with their own ideas. Because, you know, this
Right.
is a school and I want people to learn, and it's not just like a trading mill, like here's your trade of the day type of a thing.
Right, Mark. So for the folks that don't know, so you've traded with Steve Cohen. I think 35 billion plus assets under management. Mario Gabelli, like 34 billion. And he was, I think, the investor of the year in 2011. So you traded with these guys. And well, fast forward, now you are the chief educator at the Benzinga Trading School, helping retail traders pretty much through all across the world, because the trading school is international, right? So looking forward to this now, what you do now, Mark, with the students. How do you feel it helps new traders kind of navigate these markets, bringing in that experience? And if you could just talk a little bit about that, maybe some scenarios or things like that.
Well, that's part of it, right? Is the experience. And unfortunately, I don't care what career you're in, but experience only comes with time, right? And with age. So I've seen like the stuff that we're seeing now. I've seen it before. Like when that whole Reddit thing started a year and a half ago, it was so similar to the day trading that went on, in the end of the internet bubble there, where everyone thinks like, oh, I'm going to leave my job as a plumber to become a day trader. So I've seen a lot of this stuff before, and a lot of the people that are out there now that are having trading schools or talking about trading, they just haven't been around the block because they're younger. They've never seen a bad market. They saw 10 years of a bull market, and then the COVID crash was almost really like a little blip because it came right back. So I think that gave people the mindset of, oh, well, this is easy. If the market goes down, it's just going to come back. And it just doesn't happen that way. There's been a lot of periods in our history where markets go down for a long time. I mean, buy and hold is a great strategy when things are going up, like they were from 2010 to 2020. But buy and hold strategy is not a good thing when the Dow Jones takes from 1966 to 1982 to break through 1,000. So now that the markets are going down, we're going to, you're not going to be hearing much about buy and hold anymore, at least in the near future. But But yeah, so it's, I've seen these things happen before, and a lot of the people out there, they thought it was easy because everyone's a genius when the market's going higher. The rising tide lifts all boats. But now that we're starting to see it, we see hedge funds are starting to shut their doors. We see these crypto places are not giving redemptions. We're starting to see layoffs. So unfortunately, I think this could go on for a while. But we'll get a lot more insight on Wednesday when that GDP report comes out. But it would not be surprising for the market to go down another 20%, because that would put us in line with our historical valuations, and that would put us in line with what an average bear market is, which is down 35%. So I don't know whatever the math is, but we'd have to go down another 20% to get down to 35% off of the top, and that could take months. It could even take years. I would be absolutely shocked if we reversed and all of a sudden just started blasting off back to new highs. I just don't think it's going to happen. And this is not an unusual thing. I mean, markets go down too, right? What's unfortunate now is we have all this inflation, so things are a little bit different than they were over the last 10 years. So, this bounce we're having here is I guess you could say it's an oversold bounce. Sentiment got really negative, but once this thing plays itself out, my guess is we still go lower. But again, if I'm wrong, I'm wrong. The market will tell us, and we'll just see if we keep taking out the succession of trading ranges or resistance levels, that'll tell us that the market's going higher. So here's the thing, right? Markets don't go in straight lines. They go in like steps, right? They break resistance and then they make a nice move higher until they get another resistance level. And they hang out there and they break resistance and make a nice move higher until they get to another resistance level. So what we do is we watch it. Oh, this resistance breaks. All right, let's go buy. And then when we get to the next resistance level, we sell. Then if it looks like that resistance level is going to break, we buy it back. If it gets up to the next resistance level, we sell. If it looks like that one's going to break, then we jump back in. So that's how we can make money, even by being wrong on where we think the market's going to go. Because if you just let the market talk to you, it'll tell you, hey, I'm going higher, or hey, I'm going lower. And one of the ways it does is by having that whole succession of having some, seeing that stairway and seeing how it develops there. So, yeah, so we've had a bunch of good trades over the last, well, actually, I mean, really since the class started. But, some of the people got into this copper trade. I think we're going to see copper bounce. I'm down a little bit today, but it was up about 4%. A lot of the students have done really well trading some of these commodity ETFs, natural gas. Yeah, so
Right.
people might think, well, I'm not I don't trade futures, but there are ETFs that we can use that follow these commodities markets. So, if you think natural gas is going to go higher, then you can buy an ETF that will go higher as well. If your oil bill is going up, well, you can buy an oil ETF that'll go up and it'll be a hedge. You have to pay higher oil prices, but at least one of your investments has gone up. So we really kind of come up with themes, and different students have different strategies. Some are real short term, some are longer term, some are swing traders, some are day traders. So if we look at a particular market and we get the direction right, there's a lot of different ways you can trade it. A lot of it, we have the people that have the higher risk tolerance that are going to trade options. And then we have people that are more conservative that just trade the stocks. So yeah, so it's a class, man. It's a lot of interaction. There's a really good community that's forming. So yeah.
Right. And really quick here, Clark has a couple questions here. So Clark, the trial is for 7 days. It's $7.
Hey, Rodrigo,
Yeah.
while you're talking to Clark, I'm just going to step away for a minute. Okay.
All right. Yeah, no worries, man. We'll be here. And Clark, yeah, so basically the trial is the 7 days for $7. And if you want to keep it after that, it's $14.97 for the year. You do get a free laptop. That's right. Yep. And you will get Benzinga Pro as well included. So it will be the same price the next year, right? It's an annual subscription, right, to the trading school with Mark Putrino. It covers you all 4 semesters. But we're just going to wait for Mark to come back here really quick. And if you have questions, just, you can send an email as well. Yeah, I'll put the link there for you, Clark. No worries. So on the Zoom chat as well, we'll be putting it there. But on Twitter, you already know where to find it. It's on the top. It's pinned there on the top there on Twitter. And YouTube, you guys see it there on the chat. A quick shout out here to Mary, our newest member here of the trading school. Big shout out to Mary. Welcome to the family. All right, it looks like we have Mark back in the house here. What's going on? Can you hear me, Mark? I think he's muted on the other side. All right, Mark, I think he's, I don't think he knows he's muted, but
All right, sorry about that.
yeah,
It's just,
cool. All right.
I just had to respond to a text from my daughter because that's my other job, banker and chauffeur to my children. But yeah, when I think there's a lot of confusion around technical analysis and trading, and it's pretty easy to understand why. First of all, you have a lot of people that are younger and maybe they're trying really hard. And I'm talking about like when we see these trading schools or newsletters or whatever, we have people that they just don't have the experience. They might be trying hard and so forth, and they're trying to do a good job, but they just don't have the experience. They haven't been around the block too many times or enough times. Then we have the opposite end where it's people that are just downright frauds. We've seen over the last 2 years, like 2 of our biggest competitors for trading schools have each had to pay, settlements with the FTC for false advertising. You see all these like crazy things with all these, Elliott wave charts and this, that, or the other thing, harmonic charts. But in the real world, on the trading desk of Steve Cohen and on the trading desk of Mario Gabelli, I can tell you no one is looking at Elliott waves. No one is looking at harmonic charts. They're looking at what price levels are important. We're looking at what momentum is important. I got this, I'm looking at a chart here of natural gas. I know some of you can't see it, but 640 was an important resistance level for natural gas last October. Then it became support in April, and it became support again in May. And now we've just kind of fallen below that. And we got down to about 6, and now we're rallying, and now we're right up about to 640 again. So we're right at this important level. So this is probably going to make a decent sized break one way or the other over the next few days. The key is just waiting for it to happen, having the emotional wherewithal to like stay on the sidelines and not get antsy and not feel like you got to do stuff. So if we break through, there's some ETFs that the students are going to be buying. And if we don't break through, there's a chance that we're just going to start going lower. A lot of times when things get to important levels or important resistance, if they don't break through, they roll over and go lower. So we look for trades. We look for things that look like they're going to move imminently, something that's at an extreme. We don't want things that are boring. Something's in the middle of a range. The momentum's neutral. We're going to go on to something else. Something's really oversold and it's got to a support level. That's something we're going to look at. So we get our trades and we have what we call setups. And the setup is, this thing looks like it's going to move imminently. Like, for example, natural gas to me looks like it's going to make a decent sized move imminently, but it's not time to get in yet. So we call a stock or an ETF or a crypto or whatever it is you're trading that looks like it's about to move. We call that setup. That's like if it's a race, when the starters like get ready, get set, but they don't say go yet. The go is what we would call the trigger. what would have to happen for us to enter the trade? And in the case of natural gas, I would say, all right, well, if we get back above, say, 650, there's a chance we're going to keep going higher. So that would be my trigger. This thing gets into 650, that's when I buy it. Now you might be saying, well, I could buy it at 640 now. Why would I buy it at 650? Well, here's the thing. We don't know which way it's going to go. So even though we're not going to get the exact low price, or we're going to pay a higher price than we would now, the odds are going to be better stacked in our favor that it's going to go the way we want. So it's all about risk reward ratio. So when we see things that look like they're going to move imminently, we put that on our trading watch list, I guess you could say. And when a certain thing happens that tells us that reversal or that breakout or whatever, when something happens that gives us more conviction, that is what we call our trigger. And that's where we get in. So that's our class number 8. So that'll be Thursday. That is basically trading models consist of what we call the setup, the trigger, and then we have our exit strategy. So the students can go through these technical indicators, and a bunch of them are finding things that work well for them, that fits their eye. So yeah, it's been a really, really awesome experience so far, Rodrigo. It's cool watching these people, learn how to make some money and realizing that things aren't as complicated as they once thought they were. Yeah, it's just we're keeping it simple, man. It's not, we're not trying to do, we're not trying to do advanced calculus here. And as a matter of fact, all the big, not all of them, but 5 years ago, there was this big move like, oh, this fund has AI. Like if you had a hedge fund 5 years ago that used AI in your investment process, like people were just throwing money at you. Here we are 5 years later, and guess what? All of those funds, well, not all of them, but as far as I know, the vast majority of them, the performance has really been bad. And it just goes to show you, you could have all these NASA scientists, all these guys with, 190 IQs, and they overthink things. And the reality is why that stuff doesn't work is because most of AI is based on probability and statistics, and probability and statistics assumes that people are rational, and in the real world people are not rational. So we don't need all that complicated stuff, Rodrigo. We could just look at levels, trends, and momentum and pay attention to psychology, and we could, that's enough right there to be successful. So I don't know if Rodrigo is on mute or if he stepped away. But yeah, I think that's a big problem people have, is they come in with like some preconceived notion that, oh, I'm gonna find this holy grail type system that works all the time. And that's why Paul Tudor Jones is successful. And that's why Mario Gabelli is successful, because they figured out these systems. But that's just not how it works in the real world. They pay attention to, in the trading world, we pay attention to stuff like this, all right, well, oversold at resistance, or sorry, overbought at resistance, there's a good chance it's going to go lower. You can see it on a lot of different charts. So these concept of some price levels are more important than others. What's the trend? What's the momentum? Here we have Apple. And what do I want to show you on this? See, one of the things that gave us an indication that the market was about to go into this steep sell-off in early June was the way Apple reacted to this 151 level here. All right, so support, we get up to resistance. And like I said, when we get to these important levels, they tend not to trade sideways. They tend to either break through or go lower. So when it became apparent that Apple wasn't going to break above this important 151 level, then it wasn't surprising to see this, the selling coming in after that. And we had a lot of talks back here, like the market's just not going to go higher unless Apple can get above 151. And it didn't, and that's what drove the market lower here. So, Apple's important because it's the biggest stock in the market.
Right. Really quick here, Mark. And we have a question here from MG on the YouTube side. If you were looking to trade UNG. And I don't know if you already traded it in the school, but if you were trading UNG, what kind of levels would you be looking at for triggers?
Well, if I was UNG is a natural gas ETF. So I would probably be looking not at the ETF. I would look at natural gas because just by the way these things are constructed, they're going to be more volatile. But we can see here that this particular level here, let's call it 2185, kind of corresponds to that 640 level we were looking at. Let's see here. All right, yeah, so see how it's much clearer on here? Right, like you see how these two sell-offs actually got down to there, but these two corresponding sell-offs didn't actually get there. So I'm not saying don't look at this. I just think you would get a better feel if you looked at the future, because the futures markets are so much more liquid. But still, I would be just honed in on this. It's like we're right on the tightrope now, right? And if we start to go higher, maybe we get to 650. Well, then you buy the UNG because that's going to start to track. And then, I think maybe the next stop here would be around 7, the support here. If it looks like we're going lower, then we can get into one of the short ETFs like cold, like KOLD, which will go up if natural gas goes down. And I would be looking right back here at this clear level here.
Right. And speaking of energy, I just want to just recall here one of the greatest calls I've seen in a while, Mark. When you were pretty much called that bottom on oil. I think the school hadn't even started. We had some pre-enrollees in the school, and they did pretty well. But I mean, that was a pretty bold call, I guess. Or how would you describe it? That call, I think it was August last year.
Yeah, well, it was actually it kind of illustrates that this stuff doesn't need to be hard, right? And so that is, for those of you who can see my chart. All right, so all right, so that was August, the weekend of August 21st. So I don't remember if it was a Sunday or a Saturday, but anyway, this is what I was looking at. And this just shows you it doesn't really need to be complicated. All right, I'm going to put in a momentum indicator down here. All right, so this is where that was right here. So what did I see? Do I have some secret method that I found on a vision quest after I ate some peyote, or some super secret calculus formula I uncovered? Some guru taught me. No, it's like, oh, hey, last time we got down to 6250, there was support. We're at 6250 and we're oversold. This indicator down here, if the blue line is below this range, it indicates oversold conditions. So markets that are oversold and get to support have a tendency to bounce. And that's what happened here. And then, so this was in the, I guess it was a boot camp or whatever it was. Now let's go fast forward here. And this is the Omicron variant. This is in November. We have this nasty sell-off. Probably hard to see, but on this particular day, December 2nd, where was the low trade? 62.43. So we got to a level that was support, oversold, and we bounced. We moved higher. So, don't let the seeming simplicity of the message make you think it's not valid. We don't need to have ultra complicated things. Just by paying attention to some former levels that were important and seeing that we have oversold conditions, we saw that we were poised to bounce. So now a lot of the people probably don't trade oil, but there are ETFs that we can trade that are going to pretty much follow oil, like this being one of them here, XOP, where you could buy some of the oil stocks like ExxonMobil. So let's see. So that would have been, let's see here. All right, so that would have been this bottom here and that bottom there for the two things we just talked about on oil. But yeah, so that's a good example of it just doesn't really need to be that complicated. I saw something that was oversold, it was at support, and hey, things that are oversold and are at support have a tendency to bounce. So don't let the seeming simplicity of it make you think it's not worth paying attention to.
Right. And what I do like, Mark, is that, to be honest, it doesn't matter what you're trading. You could be trading options, you could be trading crypto, penny stocks. It doesn't matter, right? If you can't read the chart, you're not gonna do too well in the trading side.
Yeah, and the same principle, as long as it's a liquid enough market, the same principles apply. We're oil, stocks, cryptos, there's going to be some price levels that are more important than others. Things are going to reverse if they get overbought or oversold. So yeah, these principles apply to every market. And a lot of our students are options traders. And these principles are really good for options traders because option traders tend to like things that make big moves rapidly. That's where you can really profit from option strategies, right? What makes big moves if there is no news out on a stock? Well, a stock that is overbought or oversold, that's reversing or bouncing off of a resistance or a support level. So, or we break a trend. So if there's no news on something, the odds are it's not going to make a big move unless it's some longer term dynamic like we're talking about here. Trading bouncing off of a support level or a resistance level. Like going back to copper here, right? I wouldn't pull the trigger yet because we've gotten to this level here. But if this thing starts to move higher, it's oversold and it's really oversold. It's at a longer term level. There's a chance that this thing really snaps back over the next few days. And if it does, some of these stocks are going to snap back. And that's where some of these option traders are going to get involved because we see these fast, rapid moves. Could be, on this, it could be on the ETF. Yeah. So if you don't look at charts, and look at this perfect example of a long-term support level, right? So $30, that's where we just found a bottom here. That was the bottom of September, and it was also the bottom last March. So this is our example of market memory. Yeah, I mean, if you don't have a chart, if you're not looking at these charts and you're trying to trade short term, it's like you might as well just put a blindfold on and go try to walk through city traffic or something, because it's like you're just not going to know what the heck is going on. But if you look at this stuff and you know what to watch, you can. And I don't buy this myth of you can't beat the market or you can't time the market, because I've known a lot of people that can outtime the market. You just got to know the right things to look at. I mean, there are people that can outtime the market. I mean, for every buy, there's a sell, right? It's like, like when the market was peaking in December, it's like people were selling, I mean, so you can't just say oh, nobody saw it coming. Of course, people saw it coming. They're the ones who were selling, but yeah, so don't believe this. You can't, time the market, because buy and hold works. It was a great mantra for 10 years when things were just going up. But like I said, we've had long periods of our history where, where buy and hold wouldn't have worked. 1966, the Dow Jones hits 1,000, doesn't break through it until 1982. So, 16 years later. So yeah, we think of these things, if we get overbought or oversold, it's like, it's like something's like a rubber band. It gets stretched out, and when it gets stretched out too far, it snaps back. So I think the option traders do really well with this. And we also do stuff for, people that are interested in, we look at earning statements sometimes. We look at these releases from the government, a couple of different economic places. some of the government websites are good, like the Board of Labor Statistics. So by looking at all this stuff, Rodrigo, the students are learning how to teach themselves as opposed to just relying on someone they see on TV or in some chat room somewhere.
Right, good stuff there, Mark. So we've been here for quite some time with the folks here. So let's go ahead and just, if you have any closing remarks here on the markets and why the folks should give the trading school a shot here.
Well, I'll tell you what, Wednesday morning could be very significant. So you should join now so you can check out the class on Wednesday morning, because there's GDP numbers coming out, and if it's negative, it says we're in recession, and who knows what's going to happen with the market. But I think we're going to get some movement, and we'll be able to get in there and hopefully find a way to profit. But I think Wednesday is going to be a very important day, so we'll see what it brings. Based on what we see at the Dallas Fed there, though, we could come in below, we could come in negative. It would not surprise me to see a negative number again. I mean, last time we weren't surprised to see a negative number. A lot of people were, but we weren't, because of the stuff that we look at. We saw that like the supply chains were breaking down. So we weren't surprised. So anyway, so I got to actually step away now, but yeah, I think it's Wednesday's going to be a pretty interesting morning. So I hope to see all of you there. And for our new students, welcome to the class, and I appreciate it. And with that, I got to step aside here, Rodrigo. So I'll talk to you tomorrow morning. Tomorrow morning is our investment psychology class.
Okay, yeah, and that is actually literally, it's my favorite class. So I think you guys should check that one out. Mark Putrino, I want to give you a big shout out here, man, for being here with us and all that stuff. I know that you have a packed schedule here. So for those that do want to follow Mark, trade with Mark and all that stuff, you know where to find him. You can join the school. And I'm going to show you a little bit here really quick. But
all right, everybody, Rodrigo's going to stick around and answer some questions, but I'm going to hit the road, and I hope to see you in the class tomorrow morning.
All right, let's go there. Big shout out to Mark Putrino. All right, guys, so we're going to pretty much wrap this session here really quick. I just want to show you that where you can find the video library for the recordings of the class, where you can find also the live trading rooms there where you see chat. That's where we are right now. Video library, all of the recordings from Mark Putrino, all of the chapters, levels, trends, momentum, investment psychology, strategy, trading systems, a whole lot to learn from. And if you do want to access Benzinga Pro, it's free. It's included in the trading school. You just click here on Pro, it'll take you there. It's pretty much a 7-day trial for $7 on Twitter. You just have to click on the top side. It's pinned there. And on YouTube, you just click on the chat. But basically, a 7-day trial for $7. If you want to keep it, it's $14.97 with Benzinga Pro included and a free laptop. So big shout out to you guys for being here. I'll see you guys in the school tomorrow. Have a great day and happy trading, folks.